Most people believe wealth building demands constant attention. They imagine spreadsheets, daily decisions, market monitoring. This assumption stops them before they start. Research tells a different story. Over the past 2 decades, behavioral economists have documented something remarkable. The most successful wealth accumulators don't spend more time managing money. They spend less. Dr. Shlomo Benartzi at UCLA and Richard Thaler at the University of Chicago discovered this through studying retirement savings patterns across thousands of workers. Their findings, published in the Journal of Political Economy in 2004, revealed that people who automated their financial decisions accumulated significantly more wealth than those who made active choices. Why does automation work? Because it removes the single greatest obstacle to wealth accumulation: ourselves. You've worked decades, you've earned good income, yet the question persists: why hasn't more accumulated? The answer rarely involves intelligence or opportunity. It involves decision fatigue. Every day presents dozens of financial micro-decisions. Each one depletes your willpower reserves. Today, you'll learn how to eliminate those decisions entirely. This isn't theoretical advice. It's a systematic blueprint tested across thousands of households. Within 30 minutes, you can establish a complete automated wealth system. Once built, it operates indefinitely without intervention. Let's begin. Willpower functions like a muscle. It fatigues with use. Professor Roy Baumeister at Florida State University demonstrated this through decades of psychological research. His studies, compiled in dozens of peer-reviewed articles, show that every decision we make, however small, depletes our mental resources. By evening, we've exhausted our capacity for disciplined choices. Financial decisions suffer most. Why? Because they occur throughout the day. Should you purchase that item? Transfer money to savings? Review investment allocations? Each question drains you. Automation solves this problem elegantly. It removes decisions from your consciousness entirely. Consider the research of Professor Bridget Madrian at Harvard. She studied enrollment in workplace retirement plans at a major corporation. When employees needed to actively choose participation, only 49% enrolled. When the company switched to automatic enrollment, where employees were enrolled unless they actively opted out, participation jumped to 86%. Same people, same benefits. Different default. The participants who were automatically enrolled didn't just sign up more frequently, they stayed enrolled. 3 years later, 98% of the automatic enrollees remained in the plan. Only 72% of active choosers. Did automatic systems create what economists call beneficial inertia? Once established, they persist. Manual systems require constant renewal of commitment? That's exhausting. It fails. Here's what surprises people. Automation doesn't just increase savings rates, it increases investment performance. Research published in the Review of Financial Studies by Professors Christofferson, Daniswich, and Kumar examined millions of investment accounts. Active traders, those making frequent manual decisions, underperformed passive investors by an average of 6.5% annually. Decision-making destroyed value rather than creating it. Your advantage over younger people isn't energy or technological fluency. It's wisdom about your own limitations. You've lived long enough to recognize when effort produces results and when it produces frustration. Building wealth after 50 doesn't require working harder. It requires working smarter through systems that operate independently of your daily attention. Before automating anything, you need 3 specific figures. First, your monthly essential expenses. Not what you think they should be, what they actually are. Housing, utilities, groceries, insurance, transportation, medications, total them precisely. If you're married, include your spouse's expenses. Most people underestimate this number by 20 to 30%. Research from the Employee Benefit Research Institute shows that retirees typically need 70 to 80% of pre-retirement income to maintain their lifestyle. However, if you're still working, your current essential expenses provide the foundation. Second, your wealth accumulation target. Professors Amir and Ariely at Duke University found that people without specific numerical goals saved 40% less than those with concrete targets. Vague intentions produce vague results. Here's a practical framework. Multiply your current annual expenses by 25. This number, derived from the 4% rule documented in financial planning research, represents the approximate wealth needed to sustain your lifestyle indefinitely through investment returns. If your annual expenses equal €50,000, your target becomes $1,250,000 BAZD. That seems overwhelming. It shouldn't. We're not discussing how to reach it quickly. We're establishing what to aim toward through automation. Third, your monthly automation amount. Take your after-tax income, subtract essential expenses. The remainder represents your available automation capacity. Most wealth-building advice recommends saving 10 to 15% of gross income. That's reasonable for people starting in their 20s. You don't have that luxury of time. You need a different calculation. Professor Anna Maria Lusardi at George Washington University has published extensively on financial literacy and retirement preparedness. Her research indicates that households beginning serious wealth accumulation after age 50 need to allocate 20 to 30% of gross income towards savings and investments to achieve adequate retirement security. Can you reach that threshold? Perhaps not immediately. Start where you can. Automation makes increases easier over time. Here's why this matters. Compound growth accelerates dramatically in later stages. Even starting at 50, consistent automation over 15 years produces substantial results. The Journal of Financial Planning published calculations showing that someone contributing $1,500 monthly from age 50 to 65, earning 7% average returns, accumulates approximately $475,000. That's from automation alone. No inheritance, no lottery wins, no exceptional investment skill. Calculate your three numbers now, write them down. Everything that follows depends on these foundations. You'll need three types of accounts. Each serves a distinct purpose. First, a primary checking account for fixed expenses. This account receives your paycheck through direct deposit. It pays recurring bills automatically. Mortgage or rent, utilities, insurance premiums, loan payments, nothing else. Why separate this? Because it creates clarity. You'll know instantly whether your essential obligations are covered. No mixing entertainment expenses with electricity bills. No wondering if that restaurant meal affected your mortgage payment. Choose a checking account with no monthly fees and robust bill pay features. Most major banks offer these. Credit unions often provide better terms. Set up automatic payments for every fixed monthly obligation. Most providers, mortgage companies, utilities, insurance carriers offer this service. It takes 5 minutes per bill. Once established, it operates indefinitely. Second, a spending account for variable expenses. This account funds everything that isn't a fixed bill. Groceries, fuel, clothing, entertainment, dining out. You'll transfer a fixed amount here bi-weekly or monthly from your primary account. This might seem unnecessary. It's actually crucial. Research by Professors Prelich and Lowenstein at MIT and Carnegie Mellon, published in Marketing Science, demonstrates that people spend significantly less when using predetermined budgets versus open-ended accounts. The spending account creates a natural boundary. Calculate your average monthly variable expenses. Add 15% as a buffer. Transfer that amount automatically to your spending account each month. When it depletes, you stop spending in discretionary categories until next month's transfer. Third, a wealth-building account that you never touch. This account receives automatic transfers on the same day you receive income. The money goes directly to investments. You don't see it in your checking account. You don't make a conscious decision to transfer it. Dr. Daniel Kahneman, Nobel laureate in economics, documented through decades of research that mental accounting, how we categorize money psychologically, affects behavior more than actual account balances. Money that never appears in our checking account doesn't feel available to spend. It effectively doesn't exist. Your wealth-building account should be a brokerage account, not a savings account. Banks pay minimal interest. Invested assets grow substantially faster. Over 20 years, the difference between 1% savings interest and 7% investment returns transforms modest contributions into significant wealth. Setting up these three accounts takes approximately 30 minutes total. Linking them for automatic transfers adds another 10 minutes. Once completed, the system operates permanently without intervention. Most people believe investing requires expertise. It doesn't. Professor Burton Malkiel at Princeton University wrote the seminal research on this topic, culminating in his comprehensive analysis of market efficiency. His work, replicated and extended by dozens of subsequent researchers, demonstrates that actively managed investment strategies rarely outperform simple index fund approaches over extended periods. In fact, data from S&P Dow Jones Indices shows that over 15-year periods, approximately 90% of actively managed funds underperform their benchmark indices after accounting for fees. Your investment automation should be remarkably simple. Step 1. Open a brokerage account with automatic investment capability. Several major firms offer this: Vanguard, Fidelity, Charles Schwab. Choose one with low fees and strong customer service. The account opening process takes 10 to 15 minutes online. Step 2. Select 1 to 3 low-cost index funds. Don't overcomplicate this. You need broad market exposure, not exotic strategies. A reasonable approach for someone over 50, 60% stock index fund, 30% bond index fund, 10% international stock index fund. This allocation, recommended in research from the CFA Institute and documented in countless financial planning studies, balances growth potential with risk management. Specifically, look for funds with expense ratios below 6.20% annually. Vanguard's Total Stock Market Index Fund, Total Bond Market Index Fund, and Total International Stock Index Fund meet this criteria. Fidelity and Schwab offer equivalent options. Why index funds? Because they require zero active management. They automatically adjust as markets move. They charge minimal fees, and they perform better than most actively managed alternatives. Step 3. Establish automatic monthly investments. Every brokerage allows you to set up recurring purchases. You specify the amount and date. The system executes automatically. It purchases shares regardless of whether markets rose or fell that month. This approach, called dollar-cost averaging, has been extensively studied. Research published in the Journal of Financial Planning by Professor Michael Roseff demonstrates that systematic monthly investing reduces the impact of market volatility and removes the temptation to time market movements. A strategy that consistently fails. Set your automatic investment for the same day you receive income. If you're paid on the 15th, schedule investments for the 16th. The money transfers from checking to brokerage, then immediately converts to fund shares. You'll never manually initiate a trade. You'll never debate whether markets seem high or low. You'll never experience decision paralysis. The system simply operates. Step 4. Automate annual rebalancing. Once yearly, you'll want to restore your original allocation percentages. If stocks performed well, they might now represent 70% of your portfolio instead of 60%. Rebalancing sells some stock fund shares and purchases more bond fund shares to return to your... Once established, your system faces two primary threats: emergencies and impulse. Emergencies require a specific defense. The Automated Emergency Fund. Financial planning research universally recommends maintaining 3 to 6 months of essential expenses in liquid savings. This prevents you from disrupting investment automation when unexpected costs arise. Build this fund through the same automation principle before increasing investment contributions. First, establish a separate savings account receiving automatic monthly transfers. Calculate your monthly essential expenses. Multiply by 4, a reasonable middle ground. Divide by 12. That's your monthly emergency fund contribution. If your essential monthly expenses equal $4,000, your target emergency fund is $16,000. Contributing $300 monthly builds this in approximately 4.5 years. Once you reach the target, redirect that automatic transfer to investments. Impulse requires a different defense. Friction. Make accessing your wealth-building accounts deliberately difficult. Don't link them to your debit card. Don't download the mobile app. Don't check balances frequently. Research from the University of Pennsylvania's Wharton School demonstrates that people who check investment accounts more than monthly experience higher stress and make worse decisions. They react emotionally to short-term volatility. They disrupt beneficial automation. Your investment accounts should feel distant, almost forgotten. They're accumulating wealth in the background of your life, not demanding attention. If you absolutely must monitor progress, limit yourself to quarterly reviews. Set 4 calendar reminders, yearly check balances. Then note growth, feel satisfaction. Then ignore the accounts for another 3 months. One final protection: spouse alignment. If you're married, both partners must understand and commit to the automation system. Research published in Family Relations shows that financial disagreement represents one of the strongest predictors of relationship stress and divorce. Even late in life, sit together. Review the 3 accounts, discuss the automated transfers. Agree on the wealth target. Both partners should have access to view accounts but should mutually commit to non-interference with the automation. In 30 days, you'll barely remember the automation exists. In 90 days, you'll notice your wealth-building account contains more than you expected. Not because you made extraordinary sacrifices, because the system operated consistently while you focused elsewhere. In 1 year, you'll see tangible results. Your emergency fund will have grown significantly. Your investment accounts will show thousands of dollars in accumulated assets. Some months, market returns will boost balances beyond your contributions. You didn't research stocks, you didn't time markets, you simply automated. In 5 years, the transformation becomes undeniable. What seemed like small monthly transfers compound into substantial wealth. Research from the Federal Reserve Survey of Consumer Finances shows that households in their 60s who consistently automated savings over previous decades hold median retirement assets exceeding $200,000 buys. Those who relied on manual savings hold less than $50,000. The difference wasn't income, it was system. You've spent decades working for money. Now finally, you've built a machine that makes money work for you. Does this require faith? Initially, yes. You're trusting that small, consistent actions produce significant results. But this isn't religious faith. It's mathematical certainty backed by decades of financial research and millions of real-world examples. The academics who study wealth accumulation have documented this pattern repeatedly. Professors Thomas Stanley and William Danko examined over 1,000 millionaire households for their landmark research. Their finding: wealth accumulation correlates far more strongly with consistent saving and investing habits than with income level, education, or career choice. You can become one of those households, not through luck or extraordinary talent, through automation. You've now learned a complete wealth-building system that operates in approximately 30 minutes of setup time. 3 accounts, fixed expenses, variable spending, wealth building. 3 investment funds, stocks, bonds, international. 3 ongoing automations, monthly transfers, annual increases, quarterly reviews. Nothing about this system requires financial expertise. Nothing demands daily attention. Nothing depends on market timing or investment genius. It simply works, consistently, permanently. The question isn't whether automation builds wealth. Research across decades confirms that it does. The question is whether you'll implement it. Most people won't. They'll find this information interesting. They'll intend to act. Then daily life intervenes and tension fades. Nothing changes. You have an advantage they lack. Experience with your own patterns. You know intellectually that manual financial management hasn't produced the wealth you expected. You understand that willpower depletes. You recognize that complex systems fail, while simple systems persist. That wisdom makes you ready for automation in a way younger people aren't. So here's what happens next. You'll finish listening to this. You'll feel motivated. That motivation will fade within 72 hours. This is neurologically predictable. Motivation always fades. Act before it does. Today, not tomorrow, not next week. Open the first account, just one. The primary checking account for fixed expenses. 10 minutes, that single action transforms this from information into implementation. Tomorrow, open the spending account. The next day, the brokerage account. Within 1 week, you'll have the complete infrastructure. Then automation takes over. Your job becomes simply not interfering. 20 years ago, researchers began documenting the power of automated financial systems. The data has accumulated into overwhelming evidence. Automation works better than active management. Consistency beats intensity. Systems triumph over willpower. You can access that research yourself. Visit your local library or university database. Search for articles by Bernarzi, Thaler, Madrian, or Kahneman in financial and economic journals. Read the studies, see the numbers, or you can trust that decades of peer-reviewed research by Nobel laureates and tenured professors at the world's leading universities has already tested these principles on millions of people across dozens of countries. Either way, the answer remains the same. Automate your wealth building and it builds itself. You have 30 minutes to change your financial future permanently. Will you use them? The choice, as always, is yours. But now you know exactly what that choice entails and precisely how to execute it. Build your wealth machine, then let it run.